For many investors, gaining exposure to crude oil prices can be challenging. Physical investment requires significant expertise and expensive infrastructure, while derivatives trading can be complex and inaccessible for many. A simpler and more efficient alternative is investing in oil exchange-traded products, oil ETPs. Let's delve into the crude oil market and explore how ETPs fit into this landscape. Understanding crude oil benchmarks. The crude oil market is vast, with various grades of oil traded globally. However, two benchmarks dominate the scene. Brent crude, primarily used in global oil pricing. West Texas Intermediate, WTI, widely traded in the United States. Oil ETPs typically track total return indices based on futures tied to these two major benchmarks, offering an accessible way for investors to participate in the oil market. Oil futures contracts. Oil ETPs are underpinned by futures contracts. These are agreements to buy or sell a specified amount of oil at a predetermined price on a future date. Futures contracts vary in duration, ranging from short-term, 1 month, to long-term, 3 years or more. Upon expiry, contracts are settled either physically, through oil delivery, or financially, based on their market value at expiration. What drives oil futures prices? Oil futures prices are influenced by spot prices, the current market price of crude oil. Interest rates, the prevailing cost of borrowing. Storage costs, expenses incurred to store oil. An oil ETP's value reflects total return exposure to these underlying futures investments, with fees and costs factored in. Components of total return. Oil ETP returns are comprised of 3 key components. Price return, tracks price movements in underlying futures contracts. Roll yield, gains or losses from rolling expiring contracts into longer-dated ones. This can be negative contango, when new contracts are more expensive. Positive backwardation, when new contracts are cheaper. Collateral yield, the interest earned on the cash value of the investment. Because of these factors, ETP returns may differ from the performance figures quoted by mainstream oil market sources. The role of currency exposure. Oil is priced in US dollars, meaning oil ETPs also carry currency risk for non-dollar investors. To address this, currency-hedged oil ETPs are available, helping to mitigate the impact of exchange rate fluctuations. Why choose oil ETPs? Oil ETPs can be bought and sold through online trading platforms, brokers, or financial advisors. They provide a straightforward and cost-effective means of accessing the oil market without the need for specialized infrastructure or the complexities of futures trading.